So the last video we looked at how to close off our T accounts, and I explained that there's different ways of closing off T accounts depending on whether you're dealing with an asset, liability or capital account. Those accounts are going to go off into the balance sheet, or if it's revenue and expenses, the income statement accounts, those were closed off in a different way. And you'll remember that our asset accounts, all the accounts that end up in the balance sheet, have balances carried forward and balances brought forward at the end of the month. Whereas our revenue and expenses account, done sales here, that doesn't have balances brought forward or carried forward. It simply is closed off with the balance being sent off to the P&L account or income statement. And the next step, once you've closed all your accounts, is the trial balance. Now, the trial balance is simply a list of all the debit balances and all the credit balances on your T accounts. And it's a check that your double entry bookkeeping has is at least partly correct, because it means that for every debit there's a credit. So the total of your debits is equal to the total of your credits. Now that doesn't check that your debits and credits are actually in the right account. So it's only a check that for every debit amount there is a corresponding credit amount, but not that the debits and credits are actually in the right place. However, it's very useful for us to do the trial balance as a way of carrying out that little check that we haven't put any one-sided entries through the double entry bookkeeping system. So what I've done here is a very simple trial balance. You can see in these accounts that the bank account has got a balance being carried forward at the end of the month of £3,000. The balance carried forward in the bank account at the end of the month is brought forward at the beginning of the next month. And what that tells us is the bank account had more money coming in, more debits, than it had credits, money going out, and therefore there is money in the bank. Therefore this £3,000 here, our balance at the start of the next month, is a debit balance. And that debit balance goes off over here into our trial balance on the debit side. Now with the sales account, remember, with the revenue and expense accounts, we haven't got the balances brought forward and carried forward. We just transfer the balance out to the P&L account. So we've got, on the sales account, we've got £4,000 on the credit side. We didn't have anything on the debit side, and so we closed off by putting this entry here on the debit side because we had more credits than debits. Therefore, this is going into our trial balance over here on the credit side. So you might think it's a bit peculiar because it looks like, why have I got a balancing figure here on the debit side? It's telling us that there were more credits than debits. Therefore, it is a credit balance. Now all I've done is I've just named the other T accounts we would have for this month. We've got a bank account, sales, purchases, rent and capital. And you can see that the list of the debit balances and the list of the credit balances both total to £6,000. So at least that means that for every debit I've got a credit. The interesting thing is that we always have the opening balance on the capital account in our trial balance. In this case it's the £2,000 of capital the owner initially put into the business at the beginning of the month. But one of the things we have to deal with at the end of the month is we have to work out how much profit we've got, and then we transfer that profit to the capital account. But we do that after the trial balance. So the trial balance has our opening capital figure at the start of the month. And when we've worked out the profit, we can then take that profit and credit it to the capital account. So that has to be done, that crediting the profit to the capital account is the last thing you do at the end of the month after we've done a trial balance. The other thing we haven't allowed for here is the old problem of closing inventory or stock. And again, that is an adjustment after we've done our trial balance. Because at the moment, if you look at what you've got here, you've got 4,000 of sales and 3,000 here of total costs and expenses. So it looks as though the business has made a profit of £1,000. Sales, less the purchases, less the rent, we have a profit of £1,000. However, that's assuming that everything we bought here has been sold. Now, if we've actually still got some inventory or stock left, then actually we've got more profit than that. And we have to make an adjustment for the closing inventory. The closing inventory is a bit of a problem because closing inventory appears in our balance sheet as an asset, but it also reduces our cost of sales. So we deal with the closing inventory as an adjustment after the trial balance. We're going to debit closing inventory in the balance sheet. I'm assuming I've got £500 worth of stock or inventory left at the end of the month. And I'm going to credit cost of sales with the same 500. And what that's doing, this is increasing my profit because I've actually sold £2,000 worth of stock. I've got £500 of stock left. So my profit is actually 4,000 minus the purchases, but less the closing stock. So I've got £2,000 of cost, £500 of rent, so my profit has gone up to £1,500. So we have to make that adjustment, and then when we've worked out our new profit figure, that's when we transfer that final profit figure, in this case £1,500. We transfer it from our P&L account or income statement, and we put it into the capital account as a credit. And that is the final thing we do at the end of the month. Thank you for watching.